Okay, welcome back to It Pays to Save, where we're going to show you some smart, simple, successful strategies for finding financial freedom. As you know, this is a four-step program, and we're going to briefly touch on those here in a minute. But let's move on to part two of the introduction. Before we get started discussing what the Pays to Save program is all about, I want to briefly touch on what it's not about. It's not a quick get-rich program that promises you to double your money every 6 months or guarantee of buying and selling cycles in the market. This is just an easy to follow four-step program designed to help you stop living from paycheck to paycheck and drowning in debt to putting a plan together to retire rich and even make $1 million. And although that $1 million seems like an unrealistic goal, having $1 million in the bank when you retire might just be the new normal. But not to worry, because by following the examples in Paycheck to Paycheck, you may just be able to find a way to live on less and be just as happy, especially if you're not drowning in debt, and especially if you can retire without a mortgage. But it's never been more important to get started now. Remember, the earlier you start, the more you'll have. And by putting it off for 10 years, that $4 a day is only going to add up to $336,000. Even putting it off for 5 years can cost you close to $500,000. Time is the biggest factor in growing wealth, not how much money you have to get started with. Life is short, but it seems even shorter when you fail to plan for the future. It's never too late. Another mistake people make is thinking that they need a lot of money to get started. This couldn't be further from the truth. Something is better than nothing, and when it comes to growing wealth, the most important factor is not the amount of money, but the amount of time. Thanks to compounding interest. A few dollars a day at 11% won't add up to $1 million in 40 years all by itself. It needs a little help from compounding interest. In fact, compounding interest is the engine that turns small amounts of money into large fortunes. Albert Einstein said, "The greatest force in the universe is compounding interest." And he also said, "Compounding interest is the eighth wonder of the world. Those who understand it earn it, and those who don't pay it." Here's how the magic of compounding interest works. Let's say you have $1,000 earning 10% annual interest. At the end of the first year, you would have earned $100. If you were to take that $100, reinvest it with your initial $1,000, and it earned another 10%, after the second year, your $1,000 investment would now be worth $1,210. If you were to take that $1,210, invest it for a third year at 10%, your initial $1,000 investment is now worth $1,331. Letting that roll for 10 years, your 1,000 would be worth $2,797, and in 25 years, your initial $1,000 investment is worth over $12,000. That's over an $11,000 profit from your initial $1,000 investment without adding any money along the way. Benjamin Franklin said, "Money makes money, and the money that makes more money." And an old example of compounding interest is, would you rather have $1 million today or the value of a penny that doubled in value every day for a month? Well, if you took the $1 million option, you would have missed out on over $9 million by just waiting till the end of the month. Now we know there's no investment out there that's paying 100% compounded daily. This is just an example of the power of compounding interest. It's also an example of how by investing your spare change over 30 years rather than 30 days, you could easily end up with a nice payoff. The point here is even small amounts of money can grow into a large fortune thanks to the magic of compounding interest. There's another mistake that people make while investing. They get discouraged that their investments get off to a slow start and they either quit or pull their money out too early. There couldn't be a bigger mistake, and here's why. In the previous example, if you were to take your money out after the first week, your penny would have only been worth $1.28. Halfway through, your penny would have been worth $327. And 3/4 of the way through, your penny would have been worth close to $21,000. That's pretty impressive. But by just waiting another week, that penny would have been worth over $10 million. The single biggest time waster in the world is not finishing what you started. The point here is that it takes time for your money to earn interest and the money and interest to earn interest. The majority of growth happens over time. Remember, if you do nothing, you'll have nothing. Don't wait any longer. It's time to get started now. And don't forget, when it comes to compounding interest, the greatest factor is not the amount of your investment. It's the amount of time. Just look at what your spare change can add up to. That's why it's so important that you start making some small changes in your monthly expenses so that you can free up some extra money and it can start earning interest. Let your money work for you. It's not how much money you make. It's about how much you keep and how much you invest. There's never been a more important time to start taking control of your financial goals. Small changes in your savings and spending habits can lead to big changes in your financial well-being. The most important thing is that you do something. If you do nothing, I guarantee you will end up working for the rest of your life. Life is too short and we all work very hard. Plan your future now. That way you can retire rich and retire early. Everyone works too hard. Don't wait until it's too late. Plan for tomorrow, today. In part 1 of the introduction, we discussed the traits of the current millionaire. But chances are you may currently be a millionaire in the works. Let's say you started working full-time in your early 20s, earning $25,000 a year. 40 years later, you would have earned over $1 million in your lifetime. The math is pretty simple. 25,000 times 40. And if you were to get a 3% raise each year, you would have made over $1,885,000 in your lifetime. If you were a 2-income household, you would have earned $3,770,000. That's a lot of money. Also earlier in part 1, I promised I would show you the math and the path to earning $1 million with just an hourly minimum wage. So let's say you're earning $7.50 an hour. If you were to get a 3% raise each year, by the time you were to retire, you'd be making $23.75. If you were to look at that as a salary, $7.50 works out to about $15,000 a year. And if you were to earn a 3% raise each year, you can see how your salary increases year after year to an annual salary of over $47,000. So if you were to add all that annual income up over the years, the grand total would be over $1 million. Let's have a little more fun. So if you were to save $4 a day out of that $7.50 an hour, you would have to save 6.93% of your pay. But as your pay increases, the percentage of the savings decreases. We could also have a little more fun looking at how much time of your day is dedicated to saving that $4 a day. On an average 8-hour day, only 32 minutes is set aside for saving. And as your pay increases through the years, you're only looking at 10 minutes a day dedicated to saving your $4 a day. Now let's completely change things around a little bit and let's look at that $4 a day over 40 years. $4 a day equals about $1,400 a year. And if you add all of that up over the years, that $4 a day totals $57,600. And that's the only out-of-pocket money you need to become a millionaire. Just think of it, almost everybody has the potential to become a millionaire, even if you're only earning minimum wage. The American dream means many things to many people. To some, it means being your own boss. To others, it may be living rich above your wildest dreams. And to many, it means the freedom to do what you want, when you want, and where you want. For me, it's the latter. It means retiring early with plenty of money to vacation and travel whenever and wherever I choose. And retiring early when you still have the passion and energy to enjoy life. The reality is, we all have to work hard for a living, whether it's for ourselves or for somebody else. And although it's very important to have a career that you love and one that is challenging, it's also important, if not more important, to enjoy a rewarding life after your career. The sooner you start planning for your future, the sooner you can quit working, spend more time with your family, and really enjoy life. It's that simple. Let's take a quick break. We're about halfway through step 2. Welcome back. So do we all agree that investment wealth is the best strategy? Well, there's a lot of work to do before we get there, but don't worry, we'll cover everything. Now, one of the best ways to start investing is to make informed purchases and leave them alone. We're talking investing, not trading. You don't have to know how to buy low and sell high. The most important thing is that we just get started. This chart shows you that the less activity you have, the more you can earn. Warren Buffett said, if you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Leaving your money untouched is actually the quickest and easiest way to become wealthy. Investing is getting easier every day, and I'll show you the easiest and most cost-effective way to get started. I'll even show you how to purchase stock directly from the companies offering the stock, with no middleman, no minimum, and no fees. I can hear you now. If I'm living paycheck to paycheck, it doesn't matter how easy investing is. I won't be able to find an extra $1 a day, not to mention $4 a day. Don't worry, we will go over everything step by step and show you that the less you spend, the more you can save. And the more you can save, the more you'll have to invest. And the more you have to invest, the wealthier you will be. It all comes back to pluses and minuses. In order to become rich, we have to spend less and save more. Turning your negatives into positives is where it pays to save shines. And when it comes to growing your money, investing is really the easy part. Finding the money to invest is the hard part. Just like the first 2 steps of the introduction, the first 2 steps of this program are going to be the hardest, and they will probably take the most time to complete. But I'll try to make it as quick and painless as possible. In Paycheck to Paycheck is where we find the money to invest, but we must first examine your daily expenses. The heart of this plan is discovering ways to save money on everything. A penny here and a nickel there is all you need. Chances are you already have the money you need to build your fortune. You're just spending it in the wrong places, most likely paying off debt. You can easily transform your debt into wealth, and I'll show you how. We've already discussed a few ways to save, but get ready because we're really going to dig into each detail, each bill, each dollar that you're spending. And we're going to show you even more ways to save and more ways to earn. As we discussed before, the biggest obstacle standing in your way from reaching financial freedom is debt. The second step is also going to be a hard one, but living debt-free will free up the money that was being spent on monthly debt and allow you to turn it into a fortune. The most important of these 2 first steps, which are the negative steps, is drowning in debt. The money that you're paying creditors every month is the money you will need to start investing for the future. So let's dig into the biggest culprit of debt, credit cards. And though it may only seem like it's $20 payment here or a $30 payment there, Benjamin Franklin once said, "Be wary of the little expenses. A small leak will sink a great ship." If you were to ever take advice on money, who could be better to listen to than Benjamin Franklin? He's literally on the money. All of us work very hard to make a living, pay the bills, and make ends meet. But a lot of us love to live above our means and charge our way right into a bleak future of debt. If you're drowning in debt for every step you take forward, you're taking 2 steps back. Paying a creditor a portion of your hard-earned income not only takes away money from your budget, but it also prevents you from investing that money and having it grow. If you carry a balance on credit cards, you have to do whatever it takes to bring that balance down to 0. Debt will derail your plans for creating real wealth. For every action, there's an equal and opposite reaction. So let's take a look at the numbers. The average credit card balance is around $7,000, and the average interest rate is at 17%. If you were to only make your 2% minimum payment, you would be making a $140 monthly payment, and it would take you over 39 years to pay off. And by the way, you'd be paying over $15,000 for that $7,000 that you charged. Now let's look at the flip side if you can eliminate that $140 monthly payment. Let's say you put $20 aside for future purchases and you invested the remaining $120. Instead of 39 years of payments, let's just round it up to 40. You know where I'm going. At 11%, you would have earned over $1 million. Negatives into positives. Eliminating your credit card debt payment and flipping that into an investment. I'll show you the easiest way to do it. Remember, Albert Einstein said, compounding interest is the eighth wonder of the world. Those who understand it earn it. Those who don't pay it. The next two positive steps are really the easiest, but I don't want to get ahead of ourselves. We really have to focus on living within your means through the paycheck to paycheck step and getting out of debt through the drowning in debt step. So there'll be much more on this later, but let me just throw a few more numbers at you. So the running theme here is going to be $4 a day. If you can save more, great. But the $4 a day, which is $120 a month and $1,440 a year, invested at 11% would result in $1,514. If you were to take that $1,514 and add another $1,440 to it, which is $120 a month, which is $4 a day, earning 11%, by the end of the second year, you would have $3,205 in your investment plan. Before I show you the 40-year chart, this is what your out-of-pocket investment would look like. $1,440 a year, which is $4 a day, which is $120 a month. Over the 40-year period, you would have invested $57,600. Now, earning the 11%, your $1,440 a year would end up being worth over $1 million. So let's go back a slide where your initial investment totaled $57,600 and your return was over $1 million. So just that $4 a day over 40 years at 11% earned over $900,000. That's just from $57,600. It's really that easy, and I will walk you through every step of the way, but you have to examine every dollar you spend and you have to get out of debt. We've made quite a few points about money and wealth, but before we go any further, just remember, money can't buy you love and money doesn't buy you happiness. Money will, however, give you the peace of mind and a more enjoyable lifestyle. If an emergency arises, it won't set you back 6 months. And if your child is accepted into one of the best universities, it's cause for celebration, not concern. True wealth isn't about diamonds and yachts. It's about being in a place in your life when you can wake up every morning and truly enjoy it. A place without financial worries, where you can work if you want and travel when and where you want to, all the time knowing that you're financially secure. I feel like I've been repeating myself quite a bit, so we're just going to wrap up with a recap. In Paycheck to Paycheck, we discussed how you have to live within your means. You have to save wherever you can. And that small savings can make a big difference. In Drowning in Debt, we discussed how debt, and especially credit card debt, will derail any plans you have to creating financial freedom. We also discussed how you could find all the money you need to invest by flipping that credit card payment into an investment. In Retiring Rich, we discussed time. The time it takes for your investments to grow and how important it is to start now. In Making a Million, we just looked at the math. We looked at the average return of the S&P over 40 years and what investing $4 a day would look like. If you don't have 40 years, we're going to get into plenty of ways to shorten that. And if you have more than $4 a day, you'll be well better off. But the most important thing is that you start. Even if you're on the right track, you're bound to get run over if you just sit there. And there's no better way to get started than with It Pays to Save. And the most important part of It Pays to Save is the interactive spreadsheets. You're free to choose, but the choices you make today will determine what you will have, be, and do in the tomorrow of your life. And one more thing, securing your financial future can be fun. I set up the spreadsheet so all you have to do is fill in the blanks. Watch your spending slow and your savings grow. Working with these spreadsheets will be eye-opening and fun. 20 years from now, you'll be more disappointed by the things that you didn't do than the ones that you did. So throw off those bow lines, sail away from the safe harbor, catch the wind in your sails, explore and dream.
Okay, that concludes step 2. Coming up next, the overview, step 3. Please like and subscribe to this channel and visit itpaystosave.com, where you'll find the workbooks and ebooks that go along with this course, some customizable spreadsheets, some newly released and updated content, exclusive content, limited time offers, and even some freebies. Again, that's itpaystosave.com, where you'll find everything you need in one place.